Welcome to Iron Financial, the place where we help you forge a stronger portfolio and cut right through that market weakness. Today, we are putting Karyopharm Therapeutics, ticker KPTI, directly under the microscope. Look, this is not just another biotech story. No, this is a high-stakes, high-wire act. You've got Wall Street analysts on one side calling it a top pick, talking about blockbuster potential, and on the other side, you've got a balance sheet that is absolutely screaming for a lifeline. So the core question we have to answer today is this. Is Karyopharm actually building the next billion-dollar drug franchise, or is this entire structure just a house of cards, ready to collapse under its own financial weight? Let's get into it.
Okay, let's just frame this conflict right up front, because this is the fundamental battleground for KPTI. You've got the bull case over here. A major firm, Piper Sandler, slaps a $12 price target on this stock. From where it's trading now, that's nearly 90% upside potential. They're seeing a blockbuster in the making. But then you've got the bear case. And this isn't some analyst's opinion. This is from the company's own financial disclosures. A really stark admission that their cash, and let's be clear, that's the fuel that keeps the lights on and the clinical trials running, is projected to be completely gone in the second quarter of 2026. And that's not some far-off date. We are talking about months from now. This is a head-on collision between massive, world-changing potential and a really dire financial reality.
So, how are we going to break this down for you? First, we're going to examine that ticking clock, the intense, immense pressure of their timeline. Second, we'll stress test the current foundation. We need to know if their existing drug, Xpovio, is strong enough to carry all this weight. Third, we'll look at the blueprint for a blockbuster. That's the exciting clinical data that has all the bulls so energized. Then, and this is absolutely crucial, we're going to search for the cracks in the armor by digging deep, really deep into the financials. And finally, we'll forge our verdict. Is this a solid as iron opportunity, or is it just a dangerous trap?
All right, let's start with that timeline, because for a company like Karyopharm, time is literally everything. They are at a true, undeniable inflection point. They have two major late-stage clinical trial readouts right on the horizon. These are the kinds of events that could transform the company overnight. But shadowing all of that clinical promise is the relentless, unforgiving tick of that financial clock. They're in an all-out race to deliver positive data before their financial runway completely crumbles right out from under them. Every single day matters here.
Now, just look at this timeline. It really shows you just how compressed their situation is. Back in December, they get this glowing endorsement. Piper Sandler calls them a top pick. Great. But you fast forward just 2 months to February, and their own earnings call reveals that cash crunch we just talked about. Bam! The first make-or-break moment arrives in March. That's the SENTRY Phase 3 data for myelofibrosis. If that data is positive, they get a massive boost. If it fails, the pressure just intensifies tenfold. Then a few months later, mid-2026, the second big data readout comes for endometrial cancer. And right on the heels of that, sometime in that exact same quarter, their cash is projected to run dry. There is absolutely zero room for error here. Each one of these events is a do-or-die hurdle that they have to clear just to survive.
So, with that race against time clearly established, let's go and inspect the foundation. Before you even think about building a skyscraper, you have to be absolutely sure your concrete base can handle the weight. For Karyopharm, that foundation is their currently approved drug, Xpovio. It's the revenue engine that's supposed to be funding this whole ambitious expansion. So the real question is this foundation solid, or is it already showing some serious signs of strain?
Right.
Is the current business strong enough to do the heavy lifting that's required to forge a brand new blockbuster?
Okay, let's look at the hard numbers. Full-year revenue for 2025, it came in at about $146.1 million. Now that's just a hair's breadth increase over the prior year. Let's be clear, this is not explosive growth. It's basically treading water.
But in the context of a company that's burning through cash like this, treading water is a lot better than sinking.
That's exactly right. This shows a certain degree of stability in their core business. It's not crumbling, but it's not surging either. It's holding the line. It's providing a baseline of income while the company is betting the entire farm on its pipeline.
And if we drill down even deeper, we see that the lion's share of that revenue, we're talking nearly $115 million, comes from U.S. sales of their key drug, Xpovio. This is the bedrock. This is the operational engine room of the entire company. Every other ambition, every single clinical trial, every executive salary, it's all effectively paid for by the sales of this one drug in the U.S. market. It is absolutely critical to their survival.
Now, the sales mix here, this is a really critical piece of the puzzle. 60% of their U.S. sales are happening in what's called the community setting, with the other 40% in the academic or, the major hospital setting.
Okay, but why does that matter so much? I mean, isn't a sale just a sale?
Not at all. This is a very, very strong signal. It shows us that they have successfully built a sales infrastructure that can reach beyond just the major cancer centers and get into the local oncology practices where the vast majority of patients are actually treated. For a company that's planning to launch a new blockbuster drug, having this community network already built and running, well, that's a significant structural advantage. It proves they can actually execute on a commercial launch.
But hold on, here's the counterpoint. A key piece of their revenue structure just, poof, it vanished. For 2025, their total revenue included $15 million in R&D reimbursement from a partner, a company called Menarini. The company has stated clearly this payment will not recur. Now, this isn't a small number. That's more than 10% of their U.S. product revenue. So what you have is a significant and, up until now, reliable cash stream that is just gone. A structural beam has literally been removed from the foundation, and what that does is put even more pressure on the Xpovio sales team to grow revenue just to stay in the same place.
All right, so we've established the shaky foundation and that ticking clock. Now let's shift gears and really look at why Wall Street is willing to overlook all those risks. This is the blueprint for the Blockbuster. We're talking about their drug Selinexor. It's the same compound as XPVO, but it's targeting a massive new indication, myelofibrosis.
This is the bull case at its purest form, and it's the kind of potential that could make all of these financial concerns completely irrelevant, if they succeed.
Okay, before we dive into the data, you absolutely need to understand this key term, SVR35. In myelofibrosis, the patient's spleen becomes dangerously enlarged. So SVR35 simply means a spleen volume reduction of at least 35%. And this isn't just some abstract clinical metric we're talking about. For a patient, a smaller spleen means less pain, it means better organ function, and a huge improvement in their quality of life. It is the #1 goal of treatment, and it's the key benchmark for a drug's effectiveness in this disease. Okay, this is the money slide. This right here is the core of the entire bull thesis. The current standard of care, a drug called ruxolitinib, when it's used all by itself, achieves that SVR35 goal in only about 1/3 of patients. Think about that. 2/3 of patients don't get an adequate response. But just look at the phase 1 data for Karyopharm's combination, Selinexor plus ruxolitinib. They hit a 79% SVR35 rate. Let me just repeat that, 79%. It's just a staggering number. They have more than doubled the effectiveness of the standard of care. Selinexor works by blocking a protein called XPO1, which basically traps these tumor-suppressing proteins inside the cancer cell's nucleus, forcing them to do their job. It's a 1-2 punch that ruxolitinib just can't deliver on its own. This isn't just an improvement, this is a potential paradigm shift. If this result holds up in the phase 3 trial, it becomes the new standard of care overnight.
And what does a new standard of care in a market like this look like on the balance sheet? It looks like $1 billion. That is the company's own estimate for peak annual U.S. revenue. A billion-dollar drug changes everything. It pays off all the debt. It funds the entire rest of the pipeline. It turns a struggling biotech into a major player. The prize is absolutely immense. But the question remains, is this beautiful blueprint for a billion-dollar skyscraper sitting on a foundation made of sand? Can they actually survive long enough to build it? That number is completely meaningless if they go bankrupt first.
And it's not just the company tooting its own horn here. You have a direct quote from Piper Sandler's research note, right when they named KPTI a top pick. They explicitly used the phrase, blockbuster revenue potential. This is Wall Street putting its credibility on the line, reinforcing the sheer magnitude of this opportunity. And this is exactly why they have a $12 price target. They are betting that the data we just saw on the previous slide is going to be replicated in the big phase 3 trial, and that's what will unlock this massive value.
All right, the bull case is powerful, no doubt. The data is compelling. But a blueprint is just a piece of paper if you can't afford the steel and the concrete to actually build the thing. So now we have to do the hard work. It's time to stress test this company's financial structure. Let's put on our hard hats and go searching for the cracks in the armor, because that's where the risk truly, truly lies.
And the very first crack we find is a canyon. A full-year GAAP net loss of $196 million for 2025.
And just so everyone knows, GAAP stands for Generally Accepted Accounting Principles. It's the standard by-the-book way of looking at a company, and this number is the total loss after every single revenue and expense, including non-cash items, has been accounted for.
Just let that number sink in for a second. They lost almost $200 million in a single year. This is the cash burn rate. While their revenue was $146 million, their losses were significantly higher. This is a company that is bleeding cash at an alarming and frankly unsustainable rate. And every single quarter that goes by, this hole just gets deeper and deeper.
Now let's put some more numbers around that loss. This is the financial health check, and the patient is not well. They ended the year with just $64 million in cash and equivalents. Now compare that to their total debt, which stands at nearly $270 million. That is a debt-to-cash ratio of over 4 to 1. It's a very high-leverage situation.
And then look at the expenses. The annual operating expenses, that's the day-to-day cost of running the business. Things like research, salaries, marketing, that's over $230 million a year. And just the interest expense on their debt is almost $46 million a year.
These numbers, they paint a really grim picture of a company with massive financial obligations and a rapidly dwindling pile of cash to meet them.
This chart right here, this visualizes the core problem in the starkest terms possible. On the left, you see the cash they started the year with, $64.1 million. On the right, you have what they plan to spend this year just on R&D and SG&A, that's selling, general, and administrative costs. Somewhere between $230 and $245 million. The math simply does not work. Even when you factor in the revenue they're going to generate, there is a massive multi-hundred-million-dollar gap. They do not have the capital on hand to fund their own operations for a full year. This isn't speculation. This is basic arithmetic that's based on their own guidance.
And if you have any doubt about this, just listen to the CEO's own words from the earnings call. He said, "Our cash runway extends into the second quarter, and they are actively evaluating a range of financing and strategic options." Let me translate that from corporate speak for you. What that means is, we are running out of money, and we are urgently trying to figure out how to raise more.
Right. Those financing options almost certainly mean selling more stock, which dilutes the value for current shareholders, or maybe finding a partner and giving up a huge piece of their drug for cash. This is a clear-as-day admission of financial distress, and it's coming straight from the top.
So that brings us right here to the final verdict. We've seen the incredibly powerful bull case, right? A potential blockbuster drug that could completely reshape a billion-dollar market. And we've seen the severe bear case, a company with a frighteningly short cash runway and a mountain of debt. It is time to weigh the evidence. Is Karyopharm an incredible opportunity that's just staring us in the face, or is it a carefully laid trap for unsuspecting investors?
Okay, let's just put it all out on the table. The bull argument is all about potential. A potential billion-dollar drug backed by what appears to be superior clinical data and, of course, strong analyst support. They have 2 shots on goal with major data readouts this year.
But the bear argument is all about the current reality. A massive net loss, a cash runway that is measured in months, not years, a heavy debt load, and the absolute certainty that they will need to raise more capital, which is likely going to be painful for shareholders.
Look, this is not a stock you buy for its stable earnings. Karyopharm is a binary event. You are betting that their clinical data will be so overwhelmingly positive that it completely vaporizes these severe financial headwinds.
So what are the actionable takeaways here? What are the specific events that are going to determine the fate of this company? There are 3 of them. First, and most importantly, is the SENTRY trial data in March. This is the big one for myelofibrosis. A positive result here could send a stock soaring. A failure could be absolutely catastrophic. Second is the export trial data in mid-2026 for endometrial cancer. And third, and this one could happen literally at any time, is news of how they plan to solve their cash problem. You need to watch for announcements of a stock offering, a partnership deal, or some other strategic move. These 3 catalysts are what will write the next chapter for KPTI.
So, the crucial point is this. Karyopharm is building towards a massive, company-defining event with its upcoming data. They have the blueprints for something that could be truly spectacular. The question you have to ask yourself as an investor is this: is the foundation they've built solid enough to handle the weight of that payload? Or are the financial cracks in the armor so severe that the entire structure is just destined to collapse before the rocket even has a chance to leave the pad? That's the billion-dollar question.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.